Welcome to the Beginner's Guide to Betterment ETFs, a comprehensive tutorial designed to help you understand the world of exchange-traded funds and how to use them to achieve your investment goals. First, let's start with the basics. What is an ETF? An ETF, or exchange-traded fund, is a type of investment fund that is traded on a stock exchange. Like individual stocks, ETFs hold a basket of assets, such as stocks, bonds, or commodities, and are designed to track the performance of a particular index, sector, or asset class. Betterment is a popular investment platform that offers a range of ETFs to its users. The platform uses a diversified investment strategy, which means that your money is spread across different asset classes to minimize risk. When you invest in Betterment ETFs, you are essentially investing in a portfolio of ETFs that are selected and managed by the platform's team of experts. To get started with Betterment ETFs, you will need to create an account on the platform. This involves providing some basic information, such as your name, address, and social security number. You will also need to link a bank account to fund your investments. Once you have created an account, you can choose from a range of investment options, including ETFs that track the U.S. stock market, international stocks, bonds, and commodities. You can also choose from a range of pre-built portfolios, which are designed to meet specific investment goals, such as retirement or wealth accumulation. One of the key benefits of investing in Betterment ETFs is the low costs. The platform charges a management fee of just 0.25% per year, which is significantly lower than the fees charged by many traditional investment managers. Additionally, the ETFs offered by Betterment have low expense ratios, which means that you keep more of your investment returns. Another benefit of Betterment ETFs is the tax efficiency. The platform uses a tax loss harvesting strategy, which involves selling securities that have declined in value to offset gains from other investments. This can help to reduce your tax liability and maximize your investment returns. In terms of best practices, it's essential to have a long-term perspective when investing in Betterment ETFs. This means that you should be prepared to hold your investments for at least 5 years, and preferably longer. It's also important to diversify your portfolio, which means spreading your investments across different asset classes to minimize risk. Finally, it's crucial to monitor and adjust your portfolio regularly. This involves reviewing your investment returns, rebalancing your portfolio, and making adjustments as needed. The Betterment platform makes it easy to do this, with a range of tools and resources available to help you manage your investments. In conclusion, Betterment ETFs offer a low-cost and tax-efficient way to invest in the stock market. By following the steps outlined in this tutorial, you can create a diversified portfolio of ETFs that are designed to meet your investment goals. Remember to have a long-term perspective, diversify your portfolio, and monitor and adjust your investments regularly to maximize your returns.